I look at, so first of all, I've been talking about Bitcoin getting to 150 to 180 for a long time, for years here. And I figured sometime in the fall. I thought it was going to hit 150 to 180 sometime in November. I guess it's not out of the question here. You know, I mean, Josh Mann thinks it might go to 444. I don't know about that, but I do think that we're going to see an expansion in the price of Bitcoin here, because we're seeing an expansion in liquidity. And what's happening is you've got the central banks are easing. You've got the Fed is now easing, and you've got some factors here that are going to cause it to continue to ease. You've got China, who is expanding on their liquidity and their money supply, and that is going to start feeding into risk assets around the world.
Bitcoin isn't just moving, it's coiling. Beneath the surface of short-term dips, a powerful macro storm is gathering that could ignite the next explosive leg higher. Bitcoin is trading near $121,431, down about 1.8% in the past 24 hours. Yet the energy in the market is anything but weak. After shattering records with a new all-time high of $126,173 earlier this year, the world's largest cryptocurrency is once again at the center of a macro storm. James Lavish, a former hedge fund manager and market strategist, believes the old playbook tied to Bitcoin's halving cycles is fading. The early years were driven by supply shocks and mining rewards, but now, he argues, the real force behind Bitcoin's moves is global liquidity. As the block rewards shrink, hash rate, energy costs, and liquidity expansion have taken center stage. Liquidity, he notes, leads Bitcoin's price by 10 to 12 weeks, a powerful signal for what may come next. The alignment of Bitcoin's 4-year cycle with U.S. presidential elections adds another dramatic layer, especially after the regulatory chokehold of Chokepoint 2.0 under the Biden era. Lavish maintains a bold target, $150,000 to $180,000 by November, fueled by central bank easing and China's expanding money supply. And history has a rhythm, having sparks the rally, Ethereum follows, altcoins roar, and then the storm resets. The next wave may be closer than many think. Crypto's biggest moves are unfolding right now. Hit subscribe and turn on notifications so you don't miss the next explosive breakout.
Yeah, so there's a few things to unpack there. First of all, the old thinking, or the traditional thinking on Bitcoin, traditional, it's only been around 15, 16 years, but was that as you get through these market cycles, these 4-year cycles, they were attached to the supply. So the mining and the reward and the halving every 4 years. Well, that is absolutely, I believe that is absolutely the huge driver beginning in the first few cycles. But now as we get along here, and that reward becomes less and less important for just the number of Bitcoin that are out there, and just as a percentage of the new supply, it just becomes, it's not as important. What is important is the hash rate and the cost to actually mine these things. Number one, access to energy too, which they're finding all kinds of ways to mine for just pennies, per kilowatt. So that's one thing. But really, the big driver of this latest cycle, I think, is getting much more closely tied to what we just talked about, the liquidity and global liquidity and expansion and contraction of that liquidity and money supply. And so, and you're seeing that kind of in real time on a lag. What do I mean by that? Well, when you look at somebody like Michael Howell's work, he'll plot the liquidity and then he'll plot Bitcoin on a 10 or 12 week lag behind it, because it takes that long for that liquidity to see itself, to see the liquidity driver in the price of Bitcoin or in the price of gold. So it's a little bit different than securities. So that's one thing. The other thing is, if you look back at the 4-year cycle, what's interesting is that it matches up perfectly with our presidential cycle. And this last presidential cycle was extremely important. And what I mean by that is that we had quite an antagonistic cabinet previously and administration as a whole through Biden and his administration, and particularly the psychopath out of Massachusetts, Elizabeth Warren, and her anti-crypto army. I can't imagine a worse senator for the citizens of Massachusetts, but they keep electing her for God knows what reason. Just lining her pocket every year in her insider trades. But anyway, so the interesting thing is that when we had that election, you could see the run up to it, and people realized that Trump was really gaining momentum here, that the mainstream media was completely wrong, that he had a lot of support, and suddenly that quiet support he has was getting more and more emboldened. Flash forward today, it's very emboldened. But the thing is, when I launched my fund, the Bitcoin Opportunity Fund, John, which was right before the election, it was in 2023, and we experienced firsthand what became known as Chokepoint 2.0. And for your viewers who don't know what that is, Chokepoint 1.0 under the Obama administration went after industries that they didn't like. Things like firearms, guns and ammo, pornography, and what they said was, if you're a bank and you're doing business with these companies, with these outfits, that we're going to come after you. And so that was known as Chokepoint 2.0. It was pretty much behind the scenes, and they just choked off all of these businesses by the access to actual capital through the banks. If you don't have bank capital, bank access, then no surprise that something like Silk Road would pop up. But flash forward to the Biden administration, and Elizabeth Warren decided she didn't like cryptos. And so she was going to go after the crypto companies, the crypto bros. And so any business and any bank that was doing business with them was going to be scrutinized, and possibly have these long drawn out audits or whatever it may be, sanctions, quiet sanctions. And so, and we experienced it. So when we were raising our fund, we call it the Bitcoin Opportunity Fund. And it's Delaware, it was formed in Delaware. So we're a US based company under Delaware rules and operating in Nevada under Nevada rules, and all above board. We did all our registrations with the SEC above board. Everything's laid out to see. But because we had Bitcoin in the name of our fund, we're just a traditional hedge fund investing in Bitcoin companies, but banks refused to send wires. They would delay them.
Bitcoin isn't just holding its ground, it's sitting on the edge of what could be its most explosive rally yet. Bitcoin's next explosive move may be closer than many realize. James Lavish has long maintained his bold forecast: a price surge to the $150,000 to $180,000 range, potentially hitting before the year's end. His conviction is anchored in one powerful force: global liquidity expansion. With central banks easing, the Federal Reserve System softening its stance, and China flooding its economy with liquidity, the tide of capital is rising fast. Japan's new leadership, echoing pro-growth policies, is expected to keep cheap yen flowing, fueling the global carry trade and feeding risk assets like Bitcoin. Lavish underscores how declining stock and bond volatility frees up collateral, amplifying liquidity's reach. He cites Michael Howell's liquidity model at Cross-Border Capital, a sophisticated measure beyond M2, to illustrate how a leverage-driven world tends to keep liquidity climbing. And this year, he believes, that wave hasn't crested yet. Market psychology is heating up, echoing the wild energy of the dot-com boom. Traders are already eyeing a potential 40% rally from current levels, targeting around $160,000 by October. As liquidity builds and technical patterns align, Bitcoin may be on the verge of a rally that turns fear of missing out into full-blown market euphoria. Let's get back to the interview.
So first of all, I've been talking about Bitcoin getting to 150 to 180 for a long time, for years here. And I figured sometime in the fall. I thought it was going to hit 150 to 180 sometime in November. I guess it's not out of the question here. Josh Mann thinks it might go to 444. I don't know about that. But I do think that we're going to see an expansion in the price of Bitcoin here, because we're seeing an expansion in liquidity. And what's happening is you've got the central banks are easing. You've got the Fed is now easing, and you've got some factors here that are going to cause it to continue to ease. You've got China, who is expanding on their liquidity and their money supply, and that is going to start feeding into risk assets around the world. Japan has been, if you're watching Japan, they have a new prime minister who was just elected that is akin to Trump. And the thought there is that liquidity is not going to stop in Japan. And even though they are in a precarious position of being the largest buyer of their own bonds, the largest owner of their own bonds, having done yield curve control for many years here, and now sitting at a spot where their yields have spiked up significantly. And so what's going to happen there? Well, the idea is that the thought is that, look, this has been the carry trade for the world, where you can borrow yen cheap, and turn around and buy risk assets around the world. It's just access to capital on the cheap. And the thinking is that that's going to continue now with her in place. So that's a big deal. Another big deal is that, as we've seen just this dearth of volatility in both stocks and bonds recently, that means there's access to more capital, because it requires less collateral to borrow against. So that's an expansion of liquidity. I talk about Michael Howell a lot, cross-border capital. He's got a great liquidity measure that he likes to look at, that I think is probably the best that I have access to in the world. I really respect the work he's done. I don't know exactly what his calculations are, but I know what's in the pot. And so things like bond liquidity, bond volatility, shadow banking, meaning hedge fund and private capital, central bank, the QE, QT, like all that stuff is in there. And that's really the measure beyond M2. M2 is one big factor in it, but then overarching all of that is just, we're a world built on debt, on leverage, on borrowing. And that's what's going to keep driving this. And I believe that that's going to keep expanding through this year and into next year. And that cycle of liquidity is just continuing up here. And it's going to probably top out sometime next year. So the answer is, I have a high degree of confidence that we're going to continue to expand. Do we have a blow off top? Well, it would seem that that's where the market wants to go here. Just if you look at the emotion of stocks, if you look at the psychology of them, we just keep reaching new highs. It feels like we're going to get to the point here of just absolute ridiculous FOMO across the board. I don't know when that is, or how that plays out for Bitcoin, but it just feels like that. And it feels like I feel the echo of 1998, 1999 here, where you had all those internet stocks, and it was just madness. You're too young to remember this, but it was you would buy an Amazon or a Google, it would be up 20, 30, 40% in a day. You're just like, wow, do I sell it? What do I do? And then it's up another 40% the next day. You're like, oh my God, like what is, like, this is just insane. Especially the smaller ones, not the bigger ones like those. But so the problem with the market is that the breadth is very, very consolidated with the AI, the Mag sevens. That takes up the vast majority of the index now, and that's a little bit worrisome. But if you look at the indicators of what's going on and where the Fed is right now, which is they're a big driver of liquidity. I just expect liquidity to expand going into this quarter, and so I'm continuing to be long. I have hedges on in case we have some sort of black swan event. Best we can do, but by and large, we are still invested.
All signals suggest Bitcoin is entering a critical inflection point. The powerful combination of expanding global liquidity, easing central banks, and strong technical structure mirrors conditions that have historically fueled its largest rallies. Global M2 remains a key guidepost, Its expansion has consistently aligned with bull markets, while slowdowns have brought periods of consolidation. Recent stagnation in M2 growth explains Bitcoin's pause after reaching new all-time highs, but the underlying setup remains charged. As liquidity flows accelerate again, capital could flood back into risk assets, setting the stage for a surge. With momentum building and market sentiment heating up, Bitcoin may soon break from its range and ignite a powerful rally that defines the next leg of this cycle. Is Bitcoin's quiet consolidation the calm before a breakout that sends it soaring to new all-time highs? Crypto moves fast. Drop your thoughts in the comments, share this with your network, and subscribe so you're ready when the next wave breaks.